Hello, welcome back to Learn Economy. In this video, we are going to discuss a very new topic, the random walk theory. We know that market is full of uncertainties, even if we are looking into the financial market where we have to deal with stocks, shares, etc. We can see that there would be fluctuations in the stock prices. So these fluctuations can affect your ability to sell the stocks or your ability to buy the stocks, because you might be facing there can be possibilities for you to incur a loss. There can be chance for you to get a profit. So this loss profit situation, this profit loss kind of situation is something which happened as a result of two things. First of all, there is uncertainty in the market, and also there is asymmetry of information. That means that the information shared by the buyer is not shared by the seller. There would be some kind of asymmetry, imbalance in the imbalance with respect to the information which is shared by both the parties. The random walk theory, it deals with the changes in the stock prices and also the distribution of the stock prices. It looks into the distribution of stock prices at various point of time or various periods of time. It actually suggests that changes in the stock prices have the same distribution, and this is something which is independent of each other. That means that the stock prices, the stock prices in current period would be independent of the stock prices in the future or in the past. So it assumes that a past movement or trend in the stock prices or the stock market, it cannot be considered as a perfect information in order to predict the future movement of the stock prices. The theory tells that stock prices or the stocks, it takes a random and unpredictable path that makes all the methods of predicting the stock prices futile in the long run. Even though your predictions becomes accurate, this won't happen in the long run, as predictions can be accurate only in the short run. In the long run, you cannot make accurate kind of predictions, mainly because the market is uncertain. The theory believes that it is thus very much impossible to outperform the market without assuming the additional risk. Why additional risk is happening? The additional risk is happening mainly because there is some kind of uncertainty going on. So as a result of uncertainty, there is risk. This theory considers technical analysis as something which is undependable, because chart is only buy or sell a security after an established trend has developed. They will, you are going for buying or selling the stocks or shares in the market, what you do is that you will analyze the trend of the prices of the stock. You will see whether it is apt for you to go for a buying or selling. This decision could be made only after analyzing the past trend. It is only after analyzing the past trend you could make a decision. But even though you are making a decision based on the past trend, you cannot make sure that your expectation will happen, your expectation will turn into a reality. So theory, it considers fundamental analysis as undependable due to the poor quality of information collected and its ability to be misinterpreted. That means that even though you are collecting the trend, even though you are going for a trend analysis, all the information related to what you're looking for is not given in the trend. There can be certain information missing in the trend. So this might be the information, the missing information can be the one lead to a gap between your expectation and reality. So the theory, this theory, it deals with all these kinds of things. The critics of random walk theory, they say that the stocks, they do maintain a price range over a time, or they say that it is very much possible to make accurate kind of predictions if you are going for some kind of careful selection of stocks or shares, especially at the entry and exit point of going for investment. You could see that some of the efficient markets are considered to be random. For many people, this random walk theory appeared to be a matter of surprise, especially in 1973 when when Arthur Burton uh, um, he coined a term in his book, A Random Walk Down Wall Street. This has raised the eyebrows of many people. This appeared to be a matter of surprise for many people because the book has popularized the term the efficient market hypothesis, which is a theory posed by University of Chicago professor Sharp. The efficient market hypothesis deals with stock prices. It tells that you can, if you are looking at the stock prices, it has a capacity to reflect all the available information, and you can use this information to make your expectations so that the current prices can be considered to be a best approximation of the company's intrinsic value. So this information could be considered as an accurate source of information to predict the future trends. So anyone would be actually prevented from exploiting the problems in the market, or anyone could be actually anyone is all the people who are involved in the kind of market um, buying or selling in the market, they are actually prevented from being exploited. Okay, so this random walk theory is considered to be very important, especially in the arena of financial economics, where we have to deal with the shares, stocks, etc. Sharp as well as Malky, they have concluded that due to the short-term randomness of returns, investors would be better off investing in a passively managed and well-diversified fund. We know that when we are dealing with stock market, it's very important to go for a diversified fund. Especially mutual fund is considered to be a very diversified fund, so that you would be investing in in a mix of return giving assets. That means that there would be assets of highly risk nature, there would be assets of low risk nature, and there would be assets of moderate risk nature if you're going for a mutual fund kind of thing. But if you are looking for shares or stocks of a particular company, you would be very much at risk, because uh, your return would depend upon the performance of that particular stock or share in the market. So with that, we end today's video. Please like, share, and subscribe to this channel for more videos, and be a part of my Telegram group, Telegram channel to discuss your doubts. Thank you.